Good afternoon and welcome. My name's Kevin Igo, Director of PFP, and I'm pleased to be joined today by Mark Taylor of Buzzercots, who's going to present to us today concerning HMRC's latest compliance tactics. And in truth, there's never been a more important time to be aware of our clients' rights and indeed the revenue's responsibilities. And Mark's going to take us through many of the hot topics of the day, as it were. If anybody has any questions, please feel free to ask them in the usual way in the questions box. As usual, Mark has said the more difficult questions, the better. He's more than happy to deal with them. And we will be sending copies of the slides out afterwards to all of those listening. So, Mark, firstly, welcome.
Thank you.
Perhaps you'd like to give our listeners some details of your own background before we crack on.
I'd love to. Currently, as the slide shows, I'm a partner and I'm head of the Tax Investigations and Dispute Resolution team at Buzzercot. I've been in private practice now for just over 10 years, and prior to that, for my sins, I served in all the elite investigation offices, both civil and criminal, at HMRC. So I believe both through my own inside knowledge, so to speak, at HMRC and thereafter representing clients, I'm well versed to be able to give listeners today a picture as to what the latest HMRC compliance tactics are and some best tips as to allow the listeners to best protect their clients.
Okay, thank you. So without any further ado, if we crack on, those of you who are more eagle-eyed will have noticed the June 17 date at the top of the slide. That should, of course, be 18.
Okay, if we can picture the scene, we have a 24-year-old subcontractor who is unrepresented and receives payment after CIS deduction. He files his 2017 tax return in early May, unsurprisingly seeking a tax repayment given there is a surplus of CIS deducted tax over and above the 2017 tax liability. Repayment is even more important to him at this particular point in time, given he and his fiancée are just about to move in together, get married, and have their first child. Now, in this instance, his return was selected for inquiry. Now, this was the first time it'd been selected, and none of the previous 5 years had been subject. The HMRC made a request to see documentation and supporting evidence of all expenses claimed. Ordinarily, this wouldn't be such an issue. However, this particular individual had a dilemma. He realised that ahead of his house move, he had disposed of all receipts retaining to the previous 5 years of business records. What did he do? Well, he decided to be honest and make an approach and pick up the phone and phone the HMRC officer and explain to them what had happened, but also at the same time explain that he did have bank statements that did contain the entries relating to the expenses, because ordinarily the vast majority of the payments were made via tapping and switch card. However, HMRC said that wasn't good enough. It denied 90% of the expenses claimed. It then took a stance that the taxpayer's behaviour was deliberate, and then raised assessments going back to commencement and charged a 40% penalty. Rather than waiting for a cheque to come to him, he now had a tax liability of £45,000, was referred to the serious defaulters team, and was due to appear on the naming and shaming list. All of that happened from the inquiry being registered to the HMRC officer making that decision about deliberate and going back to commencement within 30 days.
Okay, so we have a quick question from Derek here. Derek's heard many stories, horror stories of dealing with HMRC, I guess such as the one you've just read. He asks, is this a typical scenario of the way HMRC are dealing with things at the moment, or are these just extreme cases? I
would say, particularly in respect to unrepresented taxpayers, I regret to say it is typical. In my experience, an unrepresented taxpayer will not be afforded the same treatment as a represented taxpayer. So I wouldn't say that this was an extreme example.
And I think I would add to that, Derek, from PFP's perspective, we see many claims where the revenue do take a far more aggressive attitude nowadays than they did even in a few years ago. Before we go on, an early question from Mike as well. Are HMRC obliged to give complete disclosure of all information and documents and data they hold on clients during an inquiry?
From my point of view, what we do, particularly during the opening phase of the inquiry, particularly now we're as we'll come on to see, we're now in your client is in a position whereby the disclosure process, there is a real emphasis on them engaging in that and enhancing any particular disclosure. So for you to do that, I would argue that it would be against your client's dare I say, human rights, but it would be against your client's interest were HMRC not to share that information. Now, there are typically two forms of investigations. There is one where it's been selected by HMRC's computer software and the officer has not got, and it's a mandatory inquiry, an HMRC officer has to investigate that case. They can't turn it down. There is also a pre-selected inquiry where an HMRC officer has looked at it and he or she has the right not to take that case on, but has decided to, and that's based on all the information that is available. I would say over 9 out of 10 cases are all cases whereby HMRC has a pre-selected risk and has concerns about various entries in the return.
Okay. Daniel has had several clients over the last year where in some cases they have proved the receipts in full or provided the receipts in full. However, in each case they did similar things and went back over 5 years. Why has it become so aggressive?
Clues in the name, HM Revenue and Customs. They're under huge internal pressures. You'll see we've recently had the tax gap figures supplied, and if anybody's studious enough to look at those, you'll see that the vast majority of those or the figures that are made up of the tax gap, actually a lot of that comes from errors, both deliberate, careless, and ones where one takes reasonable care. So HMRC believes a lot of the tax gap is down to errors, whether they be careless or deliberate, and it's why HMRC are focusing all their resources on investigations.
Thank you.
Okay, so what's in it for me? 3 points, key or core points that I'm hoping that you'll take away from today. What I call HMRC's end game, what this is all about, and it's something that obviously, hopefully, through listening to the webinar today, all of you will be a bit more aware of this particular process and don't allow yourselves to get ambushed. Presenting facts, obviously, to maximise clients' behaviour, and what that is about is where, in particular, we have issues or there are perceived errors, how one goes about in terms of presenting that to HMRC to contain the inquiry, and if there is any issues that need to be disclosed, then rather than sitting back and letting HMRC drive this, actually yourselves take control, and particularly where you're providing HMRC with information and yourself working out what quantifying what the exposure is, that you're actually enhancing that and you're promoting that and you're shouting that from the rooftops. Now, there are 3 stages of an inquiry. And obviously, as you can see up on the slide, in terms of the opening, working, and conclusion, and the thing to be alive to is that here, that what you say and how you say it in these 2 phases, the opening and the working of the inquiry, determines the outcome. Now, if there is exposure, how to manage that to minimise the exposure to the client, the behaviour, how to maximise the behaviour of your client or that's led to any potential errors, how one goes about that, the strategy involved, having a planned strategy that will drive you towards the outcome that is in the best interest for your client, regularly reviewing that strategy. I mean, it's ironic that I'm here this week. Well, I know Kevin's a big history buff in terms of this is actually this week is the anniversary of Waterloo. And the historians will tell you that Napoleon clearly underestimated Wellington and famously said the Battle of Waterloo will be over by lunch. So it's very important that people don't underestimate HMRC, don't underestimate the inquiry process, and are alive to all the potential issues so that they best protect their clients. Now, before we go into HMRC's tactics and topics, I'm going to bit of a flashback here in terms of I'm going to take you on a bit of a journey through because I want to recap the assessment powers, the behaviours, what they are, what they mean, how they impact your client. I also quickly want to go over the penalty powers because they're really the tools that then lead us to how and they are the core of what HMRC officers do to lead them into their inquiry process. Now the slide currently up shows the because obviously following the 2003 merger, I was there when it happened. Obviously we had two organisations coming together. HM Customs and Excise and the Inland Revenue, and clearly there was different powers for the different organisations. So in 2009-10 and onwards, there was a harmonisation of powers, which, as you can see from this slide, firstly effective VAT and then direct taxes and on. In terms of the qualifying conditions for assessment, to be honest, there wasn't really any change in terms of those qualifying conditions, but what you can clearly see is a harmonisation and bringing all of those powers together under one act. Now, moving on, what actually then happened in terms of that harmonisation was we then had these phraseologies and these powers for normal time limits and extended time limits. Now, due to the harmonisation, you can see from this from the taxes and duties on the screen that by way of harmonisation, it meant effectively there were winners and losers. So clearly, the former HM Customs and Excise officers were clearly quite happy, but the fact that their normal time limit was extended by 1 year from 3 to 4, whereas our direct tax inland revenue former colleagues were somewhat dismayed to find their normal time limits went down from 6 till 4.
So a question from Tom. It would appear HMRC's current penalty regime is designed to raise more cash, and yet they've stated their aim of penalties is to encourage the correct behaviour. How does this compare?
Well, there is a slide that is there's about 5 slides ahead, I think it is, that deals with that.
Dan asks about the assessment time windows. It's 4 years from 3 years. 4 years from when? Is that from the date they're raising the assessment?
Okay, good question. We've actually had a case where we actually had to educate the HMRC officer. It's 4 years or 6 years or 20 years from the year that you are in. So obviously, if my math serves me, we're in 1819, and obviously if we're going back 6 years, all one does is take off 6 from the 18, take off 6 from the 19, and essentially your careless time limit is 1213.
So it's 4 years preceding the year that you're actually in.
Yeah. So for 1819. It would be 1415 is our normal time limit, and it's all important. The reason why I say that is because I do regularly see HMRC officers raising assessments. So, for example, if we've got an inquiry year of, let's just say 1415, and they want to raise an inquiry or they want to raise an assessment, and then they want to apply that backwards. They go from 1415 as the starting point. That is incorrect. It's the year in which you're in. Now, moving on to extended time limits. Now, there's two, and obviously normal for the first set of extended time limits is a 6-year limit. Now the key word here is careless, as you'll see. What extends 4 to 6? Well, it's the careless behaviour of the person or another person acting on their behalf. Now, previously, I mean, I remember when these powers came out. There were literally there's that GIF that you see of that guy standing up from the boardroom table, opening the window and just walking out of the window, and that was what it was like for the direct tax guys when this was introduced, because previously careless is effectively negligence, but I'll come on to. But previously, prior to the harmonisation, it was 20 years for negligent conduct. So if you think about this, HMRC officers, they've lost 2 years from 6 to 4 for normal time limits, and for negligence, which is now the new word for that is careless, that's gone down from 20 to 6. So quite a change. And then, so what gives us the 20-year limit? Well, the 20-year limit is for extended time limits is where you have the deliberate behaviour of the person or another person acting on their behalf. So clearly, one can straight away see the difference and the importance in restricting and managing your client's exposure and possible attack by HMRC from a careless to a deliberate. Because the minute you go careless to deliberate, you're effectively exposing another 14 years. Okay, so the next slide really deals with what behaviour is all about, because this new harmonised powers brought in the phraseology behaviour, and what you have is you have 5 definitions of behaviour. Some are for the error, for the inaccuracies, and the other, for example, not deliberate is one that is particularly akin to failure to notify. So let's just whiz through these. So reasonable care, you can clearly see the definition of that is it's conduct that isn't careless, deliberate, or deliberate and concealed. Okay, that sort of makes sense. The not deliberate is conduct that is neither deliberate or deliberate and concealed. So these are essentially the ones in which would allow you to restrict the client's exposure to 4 years. And then the minute we then jump into the next categories, careless and deliberate, the deliberate and concealed is something that isn't necessary for the assessment powers, but it's there for penalty powers. So obviously, if I haven't taken reasonable care because I'm accused by HMRC, then I must be either careless, deliberate, or deliberate and concealed. So let's look at what they are. So careless is, dare I say it, the pre-harmonisation phraseology of negligence. It's essentially just a lack of due care and attention. It's as simple as that. The one thing that's important though is it's the lack of care and attention of your taxpayer or your client. And one of the things that HMRC is really pushing on is about they're almost looking at your client and what your qualifications are of your client to basically and it's almost as if they've got if your client has a maths GCSE or works in some form of industry. We had a client that worked for Santander, and HMRC hold them as being a sophisticated taxpayer, and therefore pushing the boundaries from careless to deliberate. So deliberate is clearly what I would call the old-fashioned mens rea of knowledge. It's that you knew at the time. You might not have known what the tax loss would be or what the benefit or the pecuniary advantage was going to be at the time, but you knew at the time that what you did, that you, for example, you delivered a tax return that you knew was incorrect or contained inaccuracies at the time you filed it, or you learnt of the mistake and was able to then correct it, but you then consciously decided not to. Now, deliberate and concealed, this is something where we're getting more of a push of late by officers, and in terms of knowledge enable, but it's about the concealment. So it's almost like I like to view of it as a second act, where you've got the initial deliberateness, and then there's, dare I say, a cover-up. There's something that you've done. So an easy example would be you submit a false claim, or somebody over in terms of their expenses, fabricates those and increases the amount, and then they're subsequently inquired into by HMRC, and they then produce or present to HMRC a false invoice to cover up that extraction.
So we have a few questions on the penalties. Janet and Tom both come in with similar themes. Tom, an officer has claimed the client has taken reasonable care, but the accountant should have known better. They consider the accountant has failed to take reasonable care. Hence, acting as agent for the individual, they feel a failure to take reasonable care penalty is due. What's your reaction to that?
They are that is a very new, or sort of what I would call a very new approach that has been taken by HMRC. And I think that is one in which where the presentation of what you say to HMRC is all important to sort of minimise the exposure for that. But that is definitely one of the more recent developments that we have seen, Kevin.
And do you think that's right in law that they can do that?
No, I don't.
No. I mean, Janet does mention in general, what if it's a lack of care and attention by the advisor? Well, the same applies. They shouldn't be raising a penalty because of that.
No, I mean, essentially, what should happen is the negligence of the agent shouldn't be imputed onto the client. But obviously, one of the things that you'll always get from HMRC officers is that they'll always say, well, the last port of call, the last check goes with the client, and therefore, unless it was specific technical advice that they got on a particular area that they couldn't themselves have where they've wholly relied on, then obviously they'll be first pushing for it to be falling like the foots of the client.
Okay, question from Daniel. With these penalty charges being outrageous in some cases, what do HMRC gain if they're forcing taxpayers to go bankrupt?
Statistics. I will come on to this wonderful phrase called FRP.
Kevin has good name. Kevin has a client who HMRC have said has done something deliberately because he should have known it was wrong and he did nothing about it.
Well, should have known isn't the same as did know.
Yeah.
And there is a key difference. I mean, just so you know, that what should happen internally in HMRC is if HMRC believe that it's uncovered deliberate, and particularly during the course of a compliance check, that they should be referring that up to the evasion referral team in any case, because if it's a deliberate case, then obviously HMRC's got to look at that for potentially two things: either the possibility of a criminal investigation, because deliberate conduct or deliberate behaviour is essentially fraud, and secondly, for the potential issue of Code of Practice 9 for serious fraud cases. So it would have to go up in any case, but we're seeing commonly more accusations of deliberate. When staff were initially trained in these new penalty powers, they were told the vast majority of any behaviour and failure is going to be due to carelessness. However, in the last 18 months, there's been a bigger push on deliberate, particularly on unrepresented taxpayers. And I've had HMRC officers confess to me that they've been put under internal pressure, particularly on unrepresented taxpayers, to charge deliberate penalties.
Okay, if we crack on, we do have quite a lot of questions that we're going to come back to in a while, but I'm aware we've got a lot to get through. Okay,
so and just very quickly, how does HMRC establish behaviour? Meetings, telephone calls in particular, as of once the inquiries are live, and they look back to letters and memos and emails. We do see some emails that are absolutely horrific that have been, because generally people communicate by way of email, not in the same way that they communicate with through a letter. And some of the things that we get to see and goes into HMRC's hands is not the best. So let's just give you some examples of just to sort of help cement the behaviour and the assessment of behaviour. In this particular case, we had an individual that was importing clothing made in China, delivering it both to customers outside the UK and inside the UK. The UK customers paid by way of sterling, went into the sterling account, all declared. The goods that were delivered outside the UK went into either a dollar account or a euro account. They weren't declared to HMRC. Unsurprisingly, you won't find that in that particular case that was a deliberate case, because clearly the euro and the dollar accounts were not declared to HMRC nor to the agent acting at the time, and that case went code 9. Which is the process for deliberate behaviour in serious fraud cases. In this one, we had an individual who it was some 8 years ago, but was challenged by HMRC because they sold a property in Barbados and they didn't declare capital gains tax on it. Now, one of the challenges by HMRC, and one of the things that was proven on that case, is that the individual did take advice at the time, but the advice was sought from the advisor in Barbados, who confirmed, and there was clearly the two were at cross purposes. The retired city trader was asking it from a UK perspective. The Barbados advisor was answering it from a Barbados perspective, i.e. that there is no capital gains tax in Barbados. Now, on this particular case, we were able to argue that this was careless insofar as advice was sought, but if there was any carelessness, it was the fact that that advice was not, a second opinion here in the UK was not obtained. And now on this particular case, because it was over 8 years, HMRC weren't able to assess. The last one is an example where it was initially taken up for a sideways loss relief claim, because losses were made on the yoga business that was surrendered sideways against employment income, and surprise, surprise, an HMRC challenge. We were successfully able to argue that the business was run on a commercial basis and with a view to realisation of profits, and then HMRC focused its attention to reducing the losses by attacking the expenses that had been claimed. Now, some adjustments were agreed, primarily just to move the case to closure, but in this particular case, because the accountant had been the one that had set, for example, some of the travel restrictions and some of the percentage that were disallowed, HMRC in that instance accepted that whilst there was an error, reasonable care had been taken by both the agent and the client. So in that case, it was settled without penalty. Okay, so coming back actually, Kevin, to the question that was asked, why do HMRC charge penalties? This was an extract taken from their discussion document. As you can clearly see, they don't do it as a way of raising revenue or to offset their running costs. So, forbid us for even thinking that. It's clearly because they want compliance. That's their message. However, HMRC officers have egos. They can, on occasions, appear to be biased, detached from reality, and the animation that you see in front of you actually comes from a comment that I received the first time I collected a £1 million payment on account as a result through a meeting with an advisor and their client, and the £1 million was written there and then in that meeting. And obviously there's me skipping back to my desk thinking, what a good bloke am I, and how the British taxpayers are going to love me for this. And the comment was made, Taylor, don't feel so sort of happy with yourself. I saw him walk out the building with the shirt on his back. So it can be quite in terms of the the culture there, and some of the in terms of league tables, in terms of ribbing people whose statistics aren't as good as others. It can be like that. And also one that has got to be able to recognise that now with some of the super offices that we're dealing with, Croydon down in London, South London, soon to be Stratford, where you've got 2 super centres, there are actually people now doing compliance that historically, in my time, their roles would have been admin, and that there are people now from my time that were doing admin roles that are now doing compliance work. Do they want to do it? No, they don't. But they have no choice. So the ironic thing is that you can actually get through a Code of 9 serious fraud case quicker sometimes than you can with a compliance check, and some of that is, dare I say it, self-education of us onto HMRC officers. Now, we're moving into penalties. There are, as you can see, these are the ranges in which penalties are charged, and the ones I'm just going to quickly focus on are the last 2: inaccurate returns and failure to notify. Primarily because in the vast majority of instances for compliance checks and inquiries, these are the penalties that are going to be that your clients would commonly face. Now, as you can clearly see, there needs to be 2 qualifying conditions. Firstly, that you've got to have the understated tax or a loss of repayment claim. And secondly, that the error has either got to be, when we come back to it, careless, deliberate, or deliberate and concealed. And here, hopefully this will be of use to you in terms of, it's a nice visual presentation in terms of the typical behaviours. So if I can just explain, if we go up onto the top left hand of the chart, we'll see reasonable care. If we go alongside of that to the right, you'll see that there would be no penalty chargeable. For careless, you've got a maximum of 30% and a minimum of, and with the U and the P, U is unprompted disclosure and P is prompted, and it sort of works its way down. And as you'll clearly see, that the more the degree of the behaviour, i.e. deliberate, is regarded worse than careless, so your maximum is 70 there. Deliberate concealed is clearly deemed to be worse than deliberate, so therefore it's 100%. Now, what's the difference between unprompted and prompted? Well, unprompted is an issue where HMRC hasn't come to you, you've gone to them ahead of them detecting it, and there wouldn't be, you haven't got wind of HMRC or HMRC aren't in the process of issuing something to you. Whereas prompted, clearly, as a result of HMRC intervention, it's led you to a disclosure. Now, one of the key areas here to be alive to, and a lot of HMRC officers don't appreciate this, is that, let's just say I'm being inquired into my self-employment pages, and there's and my expenses. If we go back to the scene I set with that subcontractor, let's just say if during that process he had then identified a capital gain that he hadn't declared and that he wasn't aware of. Well, because that's a separate area, and because HMRC wouldn't have raised that disclosure coming forward, you can separate them and say, okay, it's prompted on the self-employment side, but in respect to the capital gains, it's unprompted. The last bit I want to cover here is, because the enhancing I'll come on to, but the suspending of penalties. This is something that is unique to inaccuracy errors. It's unique to careless errors, and therefore you are able to suspend penalties for up to 2 years for a careless error. Now, in terms of suspending penalties, as I've just mentioned, there's been the view was taken by HMRC, and the training that was taken by HMRC has actually found to be, in my view, flawed, because what it's done is it's had this view that you can only suspend a penalty if there's a recurring event, and they've looked at this recurring event, and their definition of it and the way they've interpreted it is been proven to be wrong, because what they've looked at is rather than looking at the underlying factors, they've actually looked at what's gone wrong. I.e., if If there's an error in respect of a capital gain that that has been found, if I'm not going to in the future, in the next 2 years, file a capital gain, then therefore I can't have my penalties suspended because of the fact that it won't be recurring. Well, there's been 2 cases that have looked at of recent note on suspension, and for me they've been game changers. First, you've got the case of Paul Steady, and in that HMRC was always going to lose that, and it's bizarre how this case even came to the tribunal, because in that HMRC denied, or the officer denied, or said that maintained the position that they couldn't have carelessness because they couldn't have it suspended because they'd been careless. Well, the legislation says that you can only have it suspended if you're careless. So that case was never, HMRC was never going to win that. The Eastman case was quite an interesting one insofar as with that, they looked at the recurring event and said it's not going to happen again. And in that particular instance, what they looked at was they looked at the underlying factors and what had gone wrong, and i.e. that they could set measurable conditions that would improve that individual's robustness of record keeping and practices to ensure going forward they would be more compliant. Lastly, I'm just going to quickly fly through the penalties for failure to notify. And in this, you can clearly see the qualifying conditions where you've got the either of, and then we move on to again, you'll see this particular sheet that will explain where you've got the behaviours, and going across you've got the maximum and minimum penalties. Interesting here again is that in terms of if you've got a non-deliberate penalty or non-deliberate position, that you get, there is a greater penalty for if it's more than 12 months before before this is found. There is actually, I don't know why that's on here, but in terms of the suspending penalties, apologies, that actual slide is wrong, because we failure to notify in the right hand side, and Kevin will get these corrected before they go out. You can't actually suspend failure to notify penalties, and to be honest, it's bizarre if you think about this, that you're almost better off filing a tax return with an inaccuracy than not filing a tax return, because for failure to notify you do not get the penalty suspended.
Okay, excellent. So we have a couple of questions on penalties, should take me perhaps at this stage. With daily penalties, clients can end up with penalties of £1,300 where there's no tax liability. How have you found HMRC to be behaving in terms of cancelling such penalties, given there's no loss of tax?
We're talking here, are we failure to either provide information or file tax return?
Failure to lodge a tax return.
Yeah, well, I think in terms of those, the issue that you have is completely separate, because what you have is you've got different sets of penalties for the failure, because you've got the minute you have the notice to file the tax return, you're obligated to file that tax return even if it's a zero self-assessment position. And I think if you look at some of the tribunal and some of the cases that even regularly go, and generally they're in the summer, and you'll see them where they've followed through from people not filing the returns. Generally, the success of those and winning those at tribunal are poor. What tends to then happen is you won't get stiffer penalties for when the percentage is raised based on clearly on the tax that is due. But the failure to actually not file a return, even if one is not due, my advice would be file the return, contact HMRC so that you don't get the notice to file in the next years.
Okay. A question from Tara. She's got a client who submitted a tax return with information on it as advised by HMRC in a phone call. HMRC then changed their mind and demanded that it be treated differently. The client's now been given a penalty. Goes on to say, can she appeal against the penalty successfully? And to make the matter worse, the client then didn't tell her until it was outside of the penalty appeal period. Is it still worthwhile appealing?
Well, it would be. I mean, obviously, if it's there are two issues there. The first is dealing with the late appeal, and clearly, once you have that information, what you have to do is you have to file your late appeal quickly. There can't be a further delay, because then that further delay will essentially kill off the late appeal. So that's your first thing, and your second thing in terms of the information and using that, then yes, I mean, clearly there seem to be grounds there. I wouldn't even suggest that the taxpayer has been careless.
So, on a continued theme of late filing, in the late filing of tax returns, what's the position if HMRC stop issuing notice to file for later years? Is this a failure to file or late filing for later years? Notices to file were issued for earlier years when the taxpayer registered.
Well, if you've got a notice to file, then you've got an obligation to file. Then the responsibility essentially passes to you. The baton passes to you, and then if you then subsequently come into a chargeable position, then you have to notify HMRC within 6 months of the end of the tax year of your chargeable position. Otherwise, you'll be likely to face the failure to notify penalties.
One last one before we move on, Keith. We've got a client who transferred some land from one of his companies to his wife with a restriction on use by her. He didn't obtain a professional valuation, but did disclose the transfer at value he had estimated. HMRC refuses to take into account of the restriction effect on value because it wasn't documented, as in insisting the client's behaviour was deliberate. We're at a stage of going to tribunal if we want to challenge this. What do you feel?
My first instance, I'll go to ADR on that case, rather than tribunal, because firstly, you could everything that you say within ADR, alternative dispute resolution, is without prejudice. Number one. Secondly, it allows you to look in the whites of the HMRC officer's eyes to see essentially the caliber of the individual that you're coming against. You'll have a technical person from HMRC there, so dare I say, common sense, if needed, can be sort of knocked into the caseworker's head. And anything that you say, as I said, is without prejudice, can't be used against the client. No publicity, so ADR all the way for me on something like that initially. Okay, so this is penalty or inaccuracies that are attributable to another person. We quite actually, I wonder whether or not we could chuck HMRC in on this one, Kevin, in respect of that previous example. But I mean, clearly, I mean, in my experience, I mean, generally it's where, the only ones I've really seen these is where I've seen ones where we've got the husband who has done something with regards to the wife's return. The husband has ended up being charged the penalty. Right, so very quickly, we're all experts now on behaviour. We all understand behaviour, and we all understand that penalties affect the penalty ranges, the discovery assessments in terms of normal or 6 or 20-year extended time limits, naming and shaming, managing serious defaulters program, and obviously the first case I talked about was the naming and shaming of that individual and him being on the serious defaulters program for 2 years. So the important part here is that if you can argue, let's just say, carelessness, the time limit of 20 years is gone. So your 14 years exposure saved. Naming and shaming is gone. Managing serious defaulters program gone. Penalties on third parties gone. And the potential for suspending that penalty. So sometimes there is, I see a lot of cases where people are putting their heels in the sand with regard to admitting carelessness, but in reality not perhaps appreciating the advantages sometimes of by accepting carelessness, by doing so what you're actually minimizing. So in terms of quality of disclosure, this is clearly where one of the things that we do is we make sure that, you know, I do not get involved in what I call correspondence tennis with HMRC. They ask a question, we then send the info back. They then decide to ask another question, we then send something back. Before you know it, you're 9 months into the lifeline of an inquiry. We're very keen on taking control, making sure that HMRC shares its risks and concerns with us. As I've said, the inquiries are not, you know, over 90% of inquiries are all generated because of risk. Get HMRC to share that risk with us then take a review of our client's position, and then if there is a disclosure to make, we'll happily make that disclosure, because by doing so, by telling, helping, giving, you can then minimize the amount of penalty that can be then applied to those ranges. If you recall, a 15% penalty for a prompted carelessness is the minimum. 30% is essentially the maximum. So you can get it down to 15% by doing the following. Essentially working with HMRC, you can clearly see examples of how to tell information, how to help HMRC, and how to give access records and documents. So, you know, essentially, what we don't do is and what I wouldn't encourage is to let HMRC do all the work. I mean, the minute you have an inaccuracy, the minute you have exposure, then literally drive it forward yourselves, because this way you're maximising the quality of your client's disclosure and then therefore minimising any potential penalty. The last thing that HMRC officers are supposed to do is review, so when we get potential penalties, they are supposed to look to see whether or not a special reduction should be made, and if there's special circumstances. You know, you can sometimes get perverse penalties. You know, we had one where a client he didn't file VAT returns because he was involved with the sale of children's clothing, but happened to sell a commercial building that attracted VAT. First VAT return he'd ever made. There was a bit of a timing error with regard to the deemed disposal date. HMRC were proven to be right, and in that particular case, as a result of the penalty involved in that case was £150,000 for one little timing error. So on that, you would sort of be saying, well, could special reduction be applied? And unfortunately, we've come across instances where HMRC officers haven't even heard of special reduction. Okay, so moving on, I'm going to share with you some what I would call HMRC alerts. Some might say you know, points of concern, or, you know, these are commonly areas that we're finding and I'm going to cover these over the three phraseologies or the three life cycles of the case, i.e. the opening, the working, and the concluding. Now, when I was in HMRC, one of the things that you were always, as an HMRC officer, we always liked meetings, primarily because there were certain things that were said in meetings. You know, essentially what you say will be used against you for the collection of tax. And there's been many an instance where, but for the meeting, we wouldn't have had the adjustments, and we wouldn't have had the assessments. And certain things were said in all innocence that potentially could be taken out of context. So, and one of the things that I was responsible for, and apologies for this, but was devising a letter whereby we would actually say, rather than sort of request all of your books and records and be disruptive, how about we come to you, we meet you, and we decide what is actually relevant. We learn a bit more about your business and nature of business, and therefore minimize the disruption. Well, the reality is we wanted to get into that building, we wanted to get into that business, that premise, get into the mindset of that individual to learn more. The other thing is telephone calls. Some of you may innocently put your client's telephone number on the tax return. That number is now being used by HMRC officers when they write to clients, particularly unrepresented individuals, by saying, I'm going to phone you in the next 14 days to discuss this letter and to take this case forward. Now, those telephone calls are extremely useful to HMRC officers, and in terms of, because you've got, particularly with your unrepresented, you've got people that really don't know the process versus an HMRC investigator who knows the process. We had one guy who came to us unrepresented who talked to us about one of the phone calls where he said, I think I might need a specialist advisor, and was told by the HMRC officer, why, what have you done wrong? You must have done something seriously wrong if you want to get a specialist involved, and putting doubt in their mind. One of my pet hates, mock section 9A letters, where HMRC's missed the inquiry window, and they therefore have these 9A inquiry notices that aren't 9A inquiry notices, but you've got to be eagle-eyed to spot the difference. They look like 9A inquiry letters, and essentially, because HMRC is out of time, they're not explaining to that particular individual that HMRC's rights and powers are a lot less in those instances. The phraseology discovery inquiry, where HMRC has discovered information, or it claims it's made a discovery of information outside of the inquiry window, and then uses this phraseology, I've made a discovery, I'm entitled to all this information. Now, what's really important here is, yes, HMRC under the powers of Schedule 36 is entitled to receive information outside of the inquiry window. So it doesn't necessarily need the 9A to raise the Schedule 36, but there's got to be a balance there between HMRC launching the famous phraseology, a fishing expedition, in terms of fundamentally there has to be, if you look into the powers of Schedule 36, there's got to be a reasonable belief. There's got to be that it's for the suspicion that there is a tax that is potentially owing at the end process. In terms of the working, the phraseology of statutory records be reasonably required. Now, obviously, statutory records are records that HMRC is automatically entitled to see. However, I've seen HMRC officers claim certain things, or certain, for example, diaries, Outlook, for example, Outlook, emails are part of statutory records, whereas when you take a step out of what is statutory records, and HMRC has to be able to justify that what it's requiring is reasonably required for the purposes of its inquiry. It's in the possession of your client, or it's in their power to possess. And secondly, that by requesting all that information, it isn't putting your client to an onerous burden. Protective assessments are commonly raised. There's generally a flurry of activity by HMRC officers at the end of March, because what happens is, once you get into the new tax year, if we go back to the scenario I gave, you lose, the HMRC officer loses the minute they go into 6th of April. The 4th year that they had in the 5th of April, the previous year, has gone. The 6th year has gone. The 20th year has gone. So commonly they will raise protective assessments. There's a judgment balance as to whether or not you actually, obviously necessarily appeal those, and whether or not you would want to pursue those to tribunal, because generally they are protective, and HMRC, were they to be really challenged on those, would struggle to actually hold those good at tribunal. The discovery case, I know, Kevin, that you've recently made reference to the case of Tooth on one of your publications, and rightly so, because in that was a good case. And whilst we hear a lot of news about HMRC winning tax avoidance cases in tribunal, believe you me, they are losing quite a few on areas of discovery and penalties. Tooth is an example where an HMRC officer claimed he'd made a discovery, but in reality, the entries on the return would or should have led a reasonable officer. That information was made available, and a reasonable officer should have raised his inquiry during the inquiry time limit. The phrase where I've got years next to discovery, that actually goes back to the example I gave when I was asked earlier, where HMRC officers do not understand open years. So if I've got an inquiry into 2016 and I'm in 1819, and I, as an HMRC officer, I now believe that there are issues with regard to earlier years, I can only go back to, if it's carelessness, because I'm in 1819, we take off 6, I can only go back 1213. We commonly come across situations where HMRC officers are going back to 910 because they're taking 1516 as the starting point. Wrong. Last one is assumptions, particularly, God forbid if your client's involved in cash trades. HMRC cannot stand cash trades and use a number of tools by which they test the cash position. Take-ins build up, where they look at what the cash that your client banked, spent, and to see whether or not that is akin with the cash declarations. Minus cash position, where your client has, where HMRC claims your client has effectively miraculously been able to spend £2 with £1 with a £1 coin, because you just can't spend the amount of cash your client is claiming based on the cash turnover figure. And these are all areas that HMRC looks business economics, and where they make a number of assumptions. Don't rely on those assumptions as being accurate. You really need to look at those. And if you've got a cash trade, you've got to be alive to the fact that this could be coming your way during an inquiry. Presumption of continuity. HMRC operates on this policy of once a sinner, you've always been a sinner. And essentially, it's for you and your client to prove a negative. There was a good case called Tanya's Takeaway, where HMRC officer believed to find irregularities for 1 year, and before you knew it, he'd gone back to 20 years. Obviously the example I set at the start of this presentation, you had an instance of a guy where HMRC went back to the year dot, so commencement. If it's wrong, it's always been wrong. People are creatures of habit. That's what you'll hear from HMRC. And obviously the last one is meetings. Be very alive to requests for meetings. Is it really in your client's interest to attend a meeting with HMRC? Any request for a meeting, any attendance is entirely voluntary. So think very, very carefully before one accepts that. The vast majority of our cases, if there's going to be a meeting with HMRC, the meeting will be between HMRC and my good self, not with the client. And lastly, in terms of closing, clearly be aware of behaviour. Hopefully by now all of you are experts on understanding the exposure that behaviour presents. Multiple irregularities. You could have an instance where you could have one issue that is deliberate, 3 issues that are careless. Well, when you get to the penalties, HMRC may potentially try and wrap up all of the attacks and the penalty charges under deliberate. There is clearly that's not right. You've got one area that's deliberate, the penalty flows from that. You've got 3 areas that are careless, the exposure and the penalties run from that. It may be harder to get the penalty suspended with a taxpayer involved in deliberate irregularities, but that's another question. But they should all be separated, because clearly careless, the penalty is less than deliberate. Penalty suspension. This is my biggest bugbear. The cases of Steady and Eastman, the lessons of those have not been learnt. HMRC are very, very good at presenting to you first-tier tribunal cases. When they win, when they lose, they will turn around and say to you that's not binding in law. It's a first-tier tribunal case. Well, you've got to ask yourself the question: why didn't they appeal it? If it's that bigger, if they don't agree with it. So the reality is there are still officers out there who focus on the inaccuracy rather than the cause. If you allow your client to carry on as they are we going to get future inaccuracies? If we are, then clearly there are steps that can be taken to get that allow us to get the penalty suspended. This is a recent thing. I came across this sort of there was no real announcement on this, and what it is that quality of your disclosure, and what HMRC calls a significant period. If it's beyond 3 years, then HMRC has sort of slipped into the compliance handbook this thing called a significant period, and they will restrict your minimum penalty to 10% above the minimum. So therefore, if it's a deliberate penalty of 35% prompted, that's 35% minimum. If it's more than 3 years ago, if an HMRC officer is diligent and is following his instructions, would now cap that at 45, and you won't get lower than that. So be aware of this sort of latest change. And of course, they don't consider special reduction. There's this phraseology that you in HMRC called, we've heard of FAB and Thunderbirds and Virgil saying FAB, Papa, as he gets into the #1 space rocket. I think it was it #2? But anyway, I digress. In HMRC, there's this thing called FRB, and FRB is future revenue benefit. You might not understand why an HMRC officer's got his heel dug in on a particular issue, but they don't just look at the tax that they've collected for that inquiry year. They look at the future revenue benefit of what, particularly in the next 3 years, what have they saved the Exchequer as a result of their work? And this is one of the reasons why you're seeing their figures going up year by year. It's this FRB magic, and this FRB magic actually swings us back to the tax gap, because the tax gap is made up of a number of estimations. Well, those estimations in the tax gap are in themselves made up because of FRB, and FRB is just some officer working out what the future revenue adjustments he now has saved the British taxpayer.
Are you therefore suggesting officers make things up?
I'm just saying that they're being creative, Kevin, in terms of their adjustments. Was that a good answer?
Yeah.
Thank you. Okay. I'll just get through these again. Apologies. Okay, so hopefully by now you've appreciated what you do say and what you say in the opening and working, and all of this is dependent upon the meetings, the telephone calls, the letters, the memos, the emails. So just be alive to the potential risk and in terms of how you conduct the inquiry. So lastly, hopefully I've hit the nail on the head with regard to the 3 bullet points and the 3 core points for you to take away today.
Okay, we will get on to a number of quick questions. So Wakas, he's got a client that's come to me where they raised assessments and have charged 100% penalty due to rental property not being declared. The previous accountant agreed without objecting. Can anything be done now?
Yes, insofar as just so you know, if you look at the independent review process as well, an HMRC officer, a new officer, can come along in an inquiry and change the mind of the predecessor. So it works both ways, as far as I'm concerned. I can take over. I can be asked to get involved. And I can take a different viewpoint from the previous advisor or the accountant. Obviously, the main issue there would be in terms of whether or not there's dealing with any potential appeal or late appeal process. But can you form a different view? Yes, you can. Should you push that forward? Yes, you should. Obviously, you've just got to deal with the fact that you've been appointed recently or whatever, and there's just not a delay between you making that position known to HMRC.
Okay, thanks. What happens when an inquiry an inquiry makes errors in their calculations and assumptions? He's just coming to a close on a VAT inquiry for a client, and the inspector's made number of oversights and errors in their calculations, which have been corrected for. He's also invited the inspector to come to the office to meet with the client to bring the inquiry to a close earlier, but they declined. So now it's dragged on for over eight months. Should this be taken into account when negotiating reductions in penalties?
I would definitely say, I mean, firstly, you won't be surprised to learn that we do regularly come across instances where, dare I say it, I haven't necessarily, I wouldn't go as far as saying I've come across an HMRC officer that's made deliberate mistakes, but have I come across ones that have made careless ones? Absolutely. And it's quite ironic when they're alleging that your client's been careless, yet they themselves have been careless through the process. All one can do is use that information in terms of for the disclosure and enhancing the disclosure.
Okay, a notice to deliver a tax return issued was not required as all income had been taxed at source, so we intended to notify HMRC of this and not complete the return. However, the Department of Work and Pensions figure from HMRC vastly understated as client took a deferred lump sum, which hasn't been included. Does this need to be disclosed to HMRC as this is their error and not the client?
Well, the first question is have they had a notice to file? If they haven't had a notice to file, as I've said, the baton passes on to the individual, and the question therefore is has the client for that tax year chargeability to tax? If they have, then they need themselves to notify HMRC. It doesn't matter whether or not, if they're late in doing so, then they may well have a reasonable excuse, or we go back to a non-deliberate reasonable excuse for filing it or notifying late. But clearly, if a client at any point is aware that there is chargeability to tax, then there is an obligation on them to notify that.
Okay, thank you. Well, thank you all for listening. I think we'll bring it to a close there. It's been a very interesting talk, so thank you for that, Mark. I'll take this opportunity to mention our Tax Investigations Conference, which Mark was a speaker last year. This year's guest speaker is Penny from HMRC, the Director General for
I'll be there.
So please, if you're interested in that or indeed any of our products, please do get in touch. This has been one of a number of our webinars that we do throughout the year for our member firms and selected guests. I sincerely hope you've enjoyed it. We have covered an enormous amount of ground today, so thank you for listening and hope to speak to you again soon.
Thank you very much, Kevin.